Markets are gearing up for the next Fed meeting coming up in a few weeks. And as we're speaking today on Wednesday, risk assets are performing quite well, except for Bitcoin. And we'll talk about that. Joining us today is renowned economist Jim Bianco, president of Bianco Research, LLC. Jim will be joining us for the first time on Kitco. Welcome to the show, Jim. Pleasure to have you.
Thanks for having me.
Lots to discuss today. Let's break down Fed expectations first, because that's what people are concerned or talking about. It seems to me that market participants are pricing in a likelihood of a 75 basis point rate hike. I'm looking at the Fed Watch tool, anywhere between 78 to 80% probability. Your expectations, are you agreeing with consensus right now, Jim?
Yeah, my expectations, I've always said, are very simple. Whatever the Fed Watch tool says is what I think is going to happen. Since it's got, as you pointed out, about an 80% chance that the Fed's going to raise 75 basis points to 3 to 3.25 range, the third 75 basis point move in a row. That's what I think that they're going to wind up doing. Underscoring that is the Wall Street Journal today. Nick Timiraos, the chief economics correspondent, wrote a piece where he said Fed officials are not pushing back on the idea that the market is pricing in 75, because yesterday, and even into early yesterday, it was still pricing about a 55% chance that the Fed was going to raise 75. Well, his story was interpreted as a signal from the Fed through the Wall Street Journal, similar to what we saw in June, and the odds shot up to 80%. Add into that, the Bank of Japan moved 50 basis points today. The ECB is expected tomorrow at their meeting to move 75 basis points. The table is set now that the Fed is going to stay uber aggressive in raising rates and dealing with the inflation problem. And at this point, even next week's August CPI report probably won't move the needle unless it's a gigantic surprise that could move the needle later on for November or December if it's confirmed with subsequent reports. But I don't think even that could change what's going to happen in 2 weeks.
You mentioned that just until recently, the expectations for a 75 basis point hike were lower. What changed, Jim? What are these signals that you mentioned?
I think what's changed is the focus on inflation away from the peak to the natural level. And what I mean by that is, everybody on Wall Street was talking about, I think inflation peaked at 9.1% in June. Look, I do too. But that's not that important. What is important is, if inflation is on its way down, where's it going to settle out? And I think more and more people are starting to think not 2%, maybe 3, maybe 4, maybe 5, somewhere in that range to be determined, but basically not 2%. And if that's the case, the Fed's got a lot more rate hiking to do. The Fed has defined neutral, and I think they're right on this, as 50 basis points above the inflation rate. Well, if the inflation rate is 4, then neutral is 4.5. That's just neutral. They haven't even started to tighten then at that point. So I think what's changed is this belief of, forget about whether or not we peak. That's not as important as, we're not going back to 2. We're probably going to stop at something higher.
That's consensus expectations. Do you agree? I mean, what's your own personal view on inflation?
Well, the consensus expectations, I think, is still this idea that we were going to go to 2, but it's starting to come off of that. And it's starting to move closer to 2.5 to 3. I'm more in the 3 to 4 to 4.5 range. I still think that inflation is going to be a lot stickier than the consensus thinks. Even though the consensus is raising their number, 60 days ago, they were still thinking 2% was a realistic chance once we got inflation peaked, which is why you're not hearing people talk about peak inflation anymore, because that's what's important when you said, yeah, as soon as we peak, we're going to 2. But now that you think we've peaked, when we're not going to 2, we need to talk about where we're going to settle out, and more of the numbers getting higher.
You know what's interesting, Jim, is that today, as I'm looking at the charts, you're right. People have become more hawkish. Expectations for a rate hike, a 75 basis point rate hike, have risen, but the dollar's down. The DXY is down 25 basis points today, as I'm looking at the charts. Why?
I think that there's 3 stories there. Story 1 is Japan. Japan has a yield curve control policy that they will not let the 10-year yield go above 25 basis points at 0.25%. That's exactly where it is right now. And since they will not let it go out, and Kuroda reiterated that, he's the head of the Bank of Japan, reiterated that last week again, if they're not going to raise rates to be more in line with the rest of the world, it weakens their currency. And the Japanese yen has just been getting smashed, which means its currency's falling relative to the dollar rising. Mm-hmm. The second story is Europe, the euro and the pound. They're getting really hurt by this gigantic energy problem that they have and the amount of money that they're going to have to spend in order to, alleviate people's energy bills this winter, the amount of money that they're going to have to borrow. And so that is a problem as well, too. That's idiosyncratic, if you will, to Europe. The third thing is the dollar is the reserve currency. So when the world gets iffy, a war in the Ukraine, fears about high energy prices, uncertainty about whether or not we're in a recession or if the globe is in a recession, what is the first thing an international investor does? Before they've finished even listing all the problems, put your money in the dollar and then figure out where you're going to go next, because it is the reserve currency. It is the safe asset. So there's a flight to safety going on. Add up all three of those. None of those stories are going away unless Bank of Japan was to cave on their policy again of 25 basis points. But I think that explains the strong dollar and why it's probably going to continue to stay strong as we move forward from here.
So just on the last point, Jim, about the dollar being a safe haven asset, a lot of people would agree with you. You're absolutely right there. Are you saying that given that the dollar is falling today, are you insinuating that geopolitical tensions around the world perhaps are de-escalating, hence a lower dollar?
No, I think that what this is that the dollar's become highly speculative right now. Okay. Its volatility's up a lot. It had a big run in the last several days through yesterday, basically up. And now you're starting to see profit taking by short-term speculators. I don't think it's anything more than that right now. I don't think what we're seeing in terms of what's happening with the currencies is suggesting that these trends towards a stronger dollar have changed.
Okay, so long-term then, your view on the dollar, is it going to continue to strengthen, you think?
Yes. One of the things in my work in looking at the currencies is currencies trend more than anything else. And the way I like to jokingly say it is people go, wow, look at how oversold the dollar is, or look at how overbought the dollar is. And I say, wait till you see how overbought it's about to get. And then it's going to get even more overbought or more oversold and more oversold. It just keeps going. Currencies tend to go and go and go. And people tend to look at them and go, wow, look at how extreme they are. And they just keep going. Case in point is the yen. From about 110, when it rose from 100 to 110, people were saying, oh, it's too much. And today it's 145, or at least it was earlier today.
What about the argument that over the medium to long term, the dollar could lose its status as the world's reserve currency, hence bringing down its value? You should see a lower DXY as a result, especially given that inflation is at 41-year highs. That should in theory, erode the value of the dollar away, should it not?
Well, there's two ways to answer that question. And the first one is everybody who's not in the United States would like to see another reserve currency other than the United States, especially if you're in the emerging market world, like us, and I'm particularly thinking about China and Russia. But just because they want another reserve currency doesn't mean that there is an alternative.
Why do they want it? I think
that the dollar's position is a problem for them. Is that what we saw? Look at Russia. When the Ukraine war came down, they were banned from the SWIFT system. Their assets were frozen at the Russian central bank. They're being hurt by our reserve status. They would very much like to have something else that we cannot dictate those kind of constraints on them. That's one of the reasons why they're actually pushing cryptocurrencies and stablecoins right now as a potential payment system. And they're looking to people like Turkey and they're looking to people like China to start paying them in different currencies other than the US. Well, just because they want it doesn't mean they're going to get it, because there isn't an alternative available. On your inflation front, yes, we have a 41-year high in inflation, but so does everybody else. And in fact, with the energy problem that is unfolding in Europe, their inflation problem might be worse on a relative scale to the United States. Their producer price inflation numbers are approaching 30% because of this booming natural gas prices in Europe and the booming electrical prices in Europe, as opposed to where we're at around 10 or 11% in the United States. So their inflation numbers are relatively worse, even though we're still at a 40-year high.
I'm going to come back to the energy crisis in Europe, Jim, towards later in the interview. That's a very important point. But to your point about an alternative to the dollar, Vladimir Putin has been very vocal in the press about developing a new BRICS-based reserve currency, a basket of currencies, if you want to call it that is basically meant to compete with the U.S.-based SDR. How successful do you think this venture is going to be?
It'll come down to basically one thing. Will the Saudis and OPEC agree that they will no longer take dollars for the payment of oil? If they can actually pull that off, and that would require a lot of pain and a lot of uncertainty for the Saudi and the OPEC countries, because they'd be getting paid into a currency that they've never been paid in, and they would have enormous amounts of that currency. And whether or not the currency markets can handle it, it's got a chance. But I don't think that the Saudis and OPEC in general are ready to start making those proclamations. Why should they put themselves through all of that heartache when it's just so much easier to take the established reserve currency of the world, the US dollar? So it comes back to what I said before. I think they all want a different reserve currency. Mm-hmm. It's just there's nothing available that can really take the place of the dollar. You have it by default.
No immediate threat to the dollar is what you're saying.
Yes. I mean, eventually over time, something could come up that could, threaten the dollar. The Chinese yuan is not ready yet because they're not a convertible currency. Their economy is not open enough. The euro's just not going to ever evolve into that. It's had 20 years to do it. I think if anything's ever going to replace the dollar, it would probably be some kind of a cryptocurrency. But Bitcoin, Ethereum, or any of the cryptos, they're many, many years away from even thinking about them being a replacement for the reserve currency. So that's not happening anytime soon.
All right, we'll come back to cryptocurrencies. Let's talk about the energy crisis in Europe, and I want to bring up a tweet that you've made, and we'll tie this into geopolitics. A couple of days ago, you tweeted that in March, the West cut off Russia from the international payment system SWIFT and froze their central bank assets. The hyper-financialized Western countries then all patted themselves in the back, thinking Russia had no answer, but they forgot Putin had his hand on a gas spigot. So we saw what happened recently. The G7 imposed new sanctions on Russia, and Russia retaliated by basically halting their natural gas sales. This tit for tat has been going on for a while. Everyone wants to know what the next step is going to be and whether or not more damage is going to come out of Europe. And what's your view?
Oh, I think definitely more damage is going to come out of Europe. What's happened in Europe is, remember now, we're talking about natural gas, not gasoline for people in the United States. Gas is used for two things. It's used for power electricity generation, and it's also used for space heating. They have enormous storage facilities, as we do in the United States, that we fill in the summer and we run down in the winter when we use it for space heating. Europe has filled their storage facilities to about 82% of their maximum as of a day or two ago, which is about where you would expect them to be in early September. But the problem is that in prior years, it would cost them 13 to 15 billion euros to do 82% full of gas. It's at 130 billion and counting right now. So Europe, the good news for Europe is you've got all the gas you need to stay warm this winter. The bad news is we're going to have to drain your bank account to pay for all that gas so that you could stay warm this winter. So they're looking at enormously large gas bills that they're going to pay. Imagine if you're in the United States and you were paying $200 or $300 a month to heat your home, and it went to $1,000 or went to $800 this coming winter. That's essentially what they're looking at. And if you run a business and you were paying $1,000 or $2,000 to heat your restaurant, you're paying $4,000 or $5,000 this winter to heat your restaurant. That's enough to bankrupt a lot of companies. And let's not forget manufacturing. Manufacturing, the single most important input to any manufacturing is cheap energy. It's not labor. And that cheap energy is gone. So Europe already has incurred that cost. It now has to spread it out. And that is going to be a very big problem for their economy. So much so, the Bank of England did something unusual last month for the first time ever. They forecasted a recession in Europe or in England to start in the fourth quarter, which is October 1st, and last for 5 quarters. Central banks never tell you that a recession is coming. They always tell you it'll be a soft landing, we'll avoid it, we could get past it, and then they'll say, okay, now it's over. And they never actually tell you one is actually coming. So obvious is this problem is the Bank of England has dropped the pretense and said, no, we're going to be in recession by the end of the year, and it'll last most of 2023.
That's interesting. What incentive do they have to make this kind of announcement? I mean, their tone is already hawkish. It's not like they can start reducing rates because they claim they're in a recession, right?
I think that their incentive is exactly that. They are hawkish. They think they have to raise rates in order to rein in their inflation problem.
Yes.
Oh, yeah, we're going to have a recession. We're going to forecast a recession, but we're still going to keep raising rates. So don't think that if in the next several months the economic data turns south and goes to minus, that somehow that's going to make us stop. We're not going to stop, is what I think they're trying to do with this.
Okay, so how does this all tie back into investments let's start with domestic investors, or domestic equities, rather. So if you're a U.S. investor looking ahead of the S&P 500, again, today is a good day for markets. The S&P is up 1.1%. And people are concerned about a lot of the things that you talked about, but it doesn't seem to me that the markets are, pricing in a huge amount of risk today. Your outlook on the markets, Jim?
Yes, they're not. I mean, we are down 16, 17% for the year. That'll be one of the worst years that we've seen, not the worst year. That was probably 2008 that we've seen in the last 20 or so if we end at these levels. But I think largely there's a legacy from investors of the last 25 years or so, pre-pandemic. Here's a problem. This is pre-pandemic. Here's a problem. It looks unattractable. What are we going to do about it? And then at the last minute, the Fed prints money, the government throws money at it, they change the rules, something comes out of the blue, and the problem magically goes away, and it's not nearly as bad as we think. There's a lot of that right now. Boy, it looks really bad in Europe, and it looks like the data is, the Fed's going to keep raising rates, and they're going to be uber aggressive, and they might actually hurt the market. But don't you worry, something will happen. The EU is meeting on Friday, and they're going to give us a magic rabbit out of a hat that's going to fix this problem, because that's the way it's always worked for the last 25 years. Now, that's true. It's always worked that way for the last 25 years. But what I've argued, the game changer now is inflation. The Fed can't drop rates to zero and print the market back to new highs like it did in 2020 when we got a pandemic and we all thought that was going to be the end of civilization.
Right.
The Fed could buy $100 billion a day of treasuries to make the market go up. They can't do that now with all the inflation. So I think that there's a little bit of hopium among investors right now. I think markets are going to continue to struggle. I don't think June 14th was the low of the year. Within that, anything that benefits from inflation, industrials, basic materials, energy, will probably do better, especially energy. I think because the market's gotten so oversold when I'm talking about crude oil prices, will probably do better than things that you would consider more long duration assets like financials and technology, as interest rates continue to head up and the economy continues to kind of limp along.
So June was not the low. I remember back in August 2020, or just the summer of 2020, when there was unprecedented monetary stimulus, people were telling me, don't fight the Fed. Go along with the flow. They're printing money. Markets are going to go up. Those calls turned out to be correct. But now, couldn't the reverse also apply? You've got hawkish stances from all central banks around the world. Like you pointed out, it's unlikely that they're going to reduce rates or pivot anytime soon. Don't fight the Fed, Jim. Shouldn't you short?
Yeah, don't fight the Fed. You should be very careful. Neil Kashkari was on a podcast 2 weeks ago. He's the president of the Minneapolis Fed, and famously said, I was happy to see the market go down after Chairman Powell's speech in Jackson Hole 2 weeks ago. They're walking around the Fed going, we want inflation down. How are we going to get inflation down? If you're an investor listening to me, they want to make you stop buying things by scaring the hell out of you with a falling stock market. That's what they want. Don't fight the Fed. I agree with that sentiment. It's just that people are thinking that, oh, they're just saying that now, but you wait, give them one or two bad payroll reports, give them another bad GDP report, and they'll cave and they'll go back to the 2010 to 2020 playbook, cut rates, start printing money, and get the market to go up. I just don't think that that environment exists anymore because of inflation.
All right, we've got a few minutes left, Jim, and then I'll let you go. But let's switch gears and talk about cryptocurrencies now. We're speaking ahead of the widely anticipated Ethereum merge, which you've done some research on. I'm just going to read one of your tweets from all the way back in May, actually. You said that BTC needs to be more than hard money for the fiat system. It needs its own ecosystem. BTC has tried and failed. ETH is the ecosystem. They both need each other. Calling ETH a shitcoin undermines BTC. So I'll let you expand on what you mean by that, and then we'll talk about the merge.
Well, I was referring to what is referred to as the Bitcoin maxis of the world. Those are the people that think that Bitcoin is the magic thing that's all you need, and that everything else is inferior to Bitcoin. And then they attack Ethereum. And I used to joke, no, go attack JP Morgan is what you want to do. Ethereum is not your enemy. We need an ecosystem. And what I mean by we need an ecosystem is we need a system of borrowing and lending and trading. And that is what you see in decentralized finance under the Ethereum protocol. And that is blossoming, and it is still a work in process. It's not there. Now, the Bitcoin people would say, oh, yes, but we had the Taproot update and we've got that coming. Well, they've been saying that for years, that they've got the Lightning Network, but they've had years and years to put that together. Bitcoin is a critical cog in this new system. It is the sound money alternative. It is like what gold was for the last 100 years. It was the anchor of the monetary system. But Ethereum is like the banking system, is really what I think it is. And the banking system needs gold, and gold needs the banking system. In the current system, just like Bitcoin needs Ethereum, and Ethereum needs Bitcoin.
Okay. Well, let's talk about the merge now. It does provide benefits to a lot of people who use Ethereum for smart contracts, for miners. It's more energy efficient. For people who stake Ethereum or want to stake, it offers higher yields. All that is great. But for the average retail investor, Jim, who probably is not going to participate in any of those things, all they want to know is whether or not this is going to have an impact on the price. What do you think?
Well, I think it is having an impact on the price. By the way, the merge is now estimated, there's to be next week on the 13th.
Okay.
So we're less than a week away from the merge, when they shift from proof of work consensus to a proof of stake consensus, just the way that they change it. You've seen Ethereum outperform Bitcoin in the lead up to the merge. You've seen the Ethereum dominance, the percentage of the entire ecosystem that is made up of Ethereum is at the highest it's been in 4 years right now. So it's been a tremendous outperformer because of the hope on the merge. Now, there's a small chance, a non-zero chance, that there's something could go horribly wrong when we switch from proof of work to proof of stake. I don't think that that's going to happen, but you can't rule that out. But I think once we get past that, it is going to open up Ethereum to being able to move on to other things where they call it sharding, with splitting up the blockchain, and making it more efficient, making it cheaper, making it something that the average investor could easily use. That will make its price more attractive. I've kind of gone out of my way to try and not predict short-term price movements in these coins, but I've been trying to really tell people this system of a new kind of financial system that we see between Bitcoin and the Ethereum protocol, and now with the merge, is something that I think is real and is going to continue to move forward. It will have its fits, it will have its starts. But I think once we get through the merge next week, it will be one of the crowning hallmark events. When we look back on the history of cryptocurrencies, the 13th, if that's when it happens, is going to be one of the more important days in their history. And as we start to understand what that opens up, it's going to make it even more positive as we move forward.
All right, Jim, finally, I want to get your outlook on the crypto markets over the medium to long term. I know you don't like to give short-term price projections, but I'm just going to read another one of your tweets from 2 days ago. BTC moves coincident with risk markets, like the S&P 500, so Bitcoin can be used as a 24/7 VIX to judge how risk appetites are trending over the 3-day holiday weekend. If you are assuming then that the equity markets have more downside to go, can you also not make the assumption that Bitcoin and the crypto markets have more downside to go and that the crypto winter is not yet over, Jim?
Yeah, I mean, I do think that that's the case. Now, if you look at Bitcoin under 19,000, it's a lot closer to its June lows than Ethereum is, which were around under $900. I mean, it's got to go down another 50% or so. But ultimately, in some other tweets I've said, while I've pointed out that Bitcoin and Ethereum are like buying a 3x or 4x or 5x S&P fund, they do the same thing. They just go up or down more. That ultimately they are not just a highly leveraged version of the NASDAQ or the S&P 500. I think once we get through the merge and people understand what this means and that it can open this up to being a new financial system, they'll start trading more independent of what the S&P or the NASDAQ does. But you're right, over the short or medium term, that's not going to happen a week from Sunday. And that ultimately, if the stock market is going to continue to struggle because of inflation and interest rates are going to continue to go up, then the highly leveraged version of risk, which is cryptocurrencies, will probably struggle. But over the medium to long term, what I want to see more than that is I want to see them start to approach a zero correlation with stocks. Then it's not just wait for the stock bull market, wait for the Fed to cut rates and print money to get Bitcoin back to 70,000 and get the S&P back to 4,800.
That's right.
That Bitcoin and Ethereum wind up finding ways to go back to their old highs, independent of whether or not the stock market is going up or down.
Perfect. Well, thank you for your thoughts, Jim, and I hope to speak to you again soon.
Thank you.
And thank you for watching Kitco News. I'm David Lin.